Interest rates are staying higher, but for how much longer? We've seen higher interest rates because we've had a strong economy, we've had a strong labor market, and we continue to see consumer spending and strong consumer confidence. Those higher interest rates have hit highs since going back to 2007 on the 10-year Treasury and back to 2000 on the 30-year fixed. But what happened this week that moved the market slightly back in our favor? And what are we waiting to hear from Jackson Hole? I want to go through a quick update on some of the economic reports that came out this week, what we're watching, and what we're still waiting to look for. So let's jump into the slide deck. So if I look at the leading economic indicator, that's one of the reports that came out this week. For 16 months in a row, the leading economic indicator has told us that we are headed for a recession. Yet, it hasn't happened yet. We went from a hard landing to a soft landing to no landing. This economy continues to maintain its resilience. Yet the leading economic indicator is telling us that we are going to have a slowdown and it's overdue. In fact, on average, historically, the leading economic indicator sits in this recessionary period for an average of 6 to 9 months. We're at 16 and we're still sitting there. So are we starting to see the cracks in our economy? The Treasury yield inversion is another leading economic indicator telling us that we're headed towards a recession. This Treasury yield inversion happened for the first time 15 months ago. Historically, on average, it happens where we hit a recession about 15 months after the initial inversion. Now, it could happen as quickly as a couple months, and it could be a little bit longer. But we're pretty much on cue to have our economic slowdown, yet we're not quite seeing it yet. But we are seeing cracks. One of the cracks is happening when we're talking about rehires. We're talking about those employers who are willing to pay more for an employee to change jobs, to leave their current employment and move to a new job. There's something called a job changer and a job stayer. Those wages have been increasing and the job changers have been getting an incredibly high increase in their wages because they were being pulled from one company to another. That is softening. Companies aren't willing to pay outrageous amounts to get somebody to change jobs right now. Yet, they're holding on to the employees that they have. We're seeing initial jobless claims has actually declined to 10,000, meaning more people are staying on the job. That initial jobless claims is something that reports when somebody loses their job and they go on unemployment for that very first week. We thought we saw a little bit of a crack when the durable goods report came out this week. Durable goods came out down 5.2%. That would be a slight celebration when you think about the fact that we're trying to celebrate a softening economy that leads us to less consumer spending, therefore a lower GDP and a softer inflation, which brings us to lower interest rates. And that's a trend that you see repeated over and over as we head into a recession. Durable goods is a measure of the things that we spend on the big ticket items, the washers, dryers, cars, airplanes, mechanicals. The durable goods fell 5.2%, but when you dive into the data, it's all around airplanes. It's all around this massive number of new airplanes that are being added to the fleets and that big equipment that's needed for those planes. Happened to be last month it was up, this month it was down. It's more just a matter of when the purchases went through. So if you remove that, durable goods is actually staying in a slightly healthy position just above the zero mark at 0.5%. It's not ready to give up yet. Mortgage purchase applications are down for the 6th straight week. In fact, we're down 5% week over week, 30% year over year. This is the lowest level or measure of demand since April 1995. So we're looking at that going that the home buyer demand is down, and this is not a surprise. A lot of buyers are sitting on the sidelines waiting for interest rates to drop. So that lower demand, though, I will tell you, will give you opportunity. If you are a buyer in this market, there are opportunities because sellers who do not sell their first weekend out on market are looking to negotiate to get that sale done. So hang on, don't go out shopping the first weekend. Watch for those homes that have been sitting on the market for more than 5 days and take advantage of more negotiating when we see less demand. No surprise that given the less demand that we're seeing less in existing home sales. But this nuance, the nuances of this number are a little bit tricky because there's also less inventory. Sellers are buyers, and right now sellers are locked in with low interest rates, so they're not selling, so they're not buying. So that's why the demand is down, and existing home sales are down because they're not putting them on the market. So existing home sales are down 2.2% month over month, down 17% year over year. Just not as many transactions happening right now. Flip side, new home sellers are taking advantage of this. Builders are absolutely taking advantage of the opportunity to fill a gap where an existing home sale might not be available. They are going to go to market to support those buyers who are out looking with a new home. So they actually hit 714,000 on an annualized basis this last month. So they take the measure of homes that are sold that month, they annualize it, it hit 714. If put that in perspective, comparatively, the average new home sales sits at 655,000 sales a year. So we're quite a bit higher than that. Then the PMI numbers came out. So PMI is just a measure of inflation that's further up the pipeline. So when we talk about inflation, most times we talk about CPI or PCE, which is the Consumer Price Index. It's more of an end inflationary number, what I feel when I go get gas or when I go to the grocery store and get gallons of milk. The PMI is really looking at more of a manufacturing number. So it's further up the supply chain, but it's looking at what are those manufacturers seeing as far as their cost of goods, and then how are they pricing when they go to sell their goods. So the PMI is a leading indicator to where inflation is headed. So we saw overnight, Tuesday night leading into Wednesday, that the PMI numbers overseas came out lower. They dropped from an expansion to a contraction. So that means that we would start to see inflation dropping. That overnight, that global effect of the slowdown and economies going towards recession impacted our markets here in the United States. We are a global market. Now, the United States is not in this contraction yet. We are still sitting slightly above the expansion line where we're still moving forward with our inflation. But we look at this globally, and it impacted our interest rates on Wednesday of this week. In fact, the 10-year Treasury dropped from a high that it hasn't seen since 2007. And we had hit like 4.34, and that number is significant because it represents a ceiling. And once you break through a ceiling, you actually have to have a pretty strong event to drop you back below the ceiling. So we hit the ceiling and came back down again, keeping us in a safer zone without having that threat of rates going even higher faster. So we had hit that high from 2007, dropped back down, and today we're sitting at 4.2% on the 10-year Treasury yield. That equates to 30-year fixed rates where we had hit 7.5, and we're now down slightly lower than that because of the PMI data. Now, all of this is still subject to what's going to happen in Jackson Hole. So Fed Chair Powell come out with a speech at 8 a.m., 8:05 to be exact, Mountain Time. And you can see this on YouTube. So the Federal Reserve has their own YouTube channel, so you can watch his speech 10:05 Eastern Time, 8:05 Mountain Time, talking about what their expectation is for the market. Where do they see rates going? Do they need to hold the Fed rate higher for longer? Do they expect us to continue to see increases this year? And when might we see a drop in the Fed rate? Now, they're not anticipating that they're going to drop the rates until 2024, but we're going to be sitting on the edge of our seats waiting for what Fed Chair Powell has to say about his expectations and watching the market economics and where he believes the rates are going to go. Because what he says matters. Last year, when they were in Jackson Hole, he said something that greatly moved the markets. Now, we had already started to see an increase in interest rates, but right here, it was when Jackson Hole was last year, and Fed Chair Powell came out on market, and he said, we need to control inflation, and we need to cause pain to both individuals and households and business owners. That pain is the only way to control inflation. Well, you can guarantee the markets didn't like hearing that at all, and it put gas on the fire, increasing our our market, our 10-year Treasury yield, and our 30-year fixed mortgage rates. So as I mentioned, this is a market mover. We'll be watching with what Fed Chair Powell said, how it's moving the markets, and what we can expect next.